Audio Jungle.
Good morning, America. I'm Samantha James, and this is 9 News. Let me tell you that today we're starting with good news. I am proud to announce you that finally Mexico's economy started showing positive symptoms. For this reason, we have a special report for you in order to identify the causes and consequences of this economic crisis that the country is currently trying to live in the past. Large amounts of foreign capital began pouring into Mexico shortly after the initial announcement of a U.S.-Mexico trade pact in 1990 and reached nearly 10% of GDP by 1993. Given the magnitude of these inflows relative to the size of the Mexican economy, much of this capital went into unproductive investment, fueling a speculative bubble in Mexican financial markets and an unsustainable boom in the domestic economy. But the capital inflows of the early 1990s were merely a catalyst. The economic crisis was a direct result of the policies pursued by the domestic monetary authority. Of particular concern were the rapid expansions of domestic credit and lending, much of it to finance real estate loans and consumer spending, and the large increase in foreign liabilities that accompanied the inflows. These problems were exacerbated by the maintenance of an inappropriate exchange rate against the dollar. Since rates of inflation were higher in Mexico than the United States in the early 1990s, the peso became progressively overvalued, stimulating imports and the flight of domestic capital. The traditional economic expansion during the final years of the Salinas administration added further pressure to the economy. The perceived strength of the Mexican economy and the liberalization of the banking and financial sectors in the early 1990s quickly attracted the attention of international investors, and by 1992, the Mexican Bolsa had become the world's second largest emerging stock market. These large capital inflows can have a destabilizing effect on the recipient's economy and balance of payment. First, capital inflows put upward pressure on the recipient's exchange rate. This is important for two reasons. First of all, the appreciation of the exchange rate reduces foreign demand for local exports and increases local demand for foreign imports, pushing the country's current account towards deficit. And second, if the exchange rate becomes highly overvalued, it encourages the flight of domestic capital. Second, capital inflows affect the size and structure of the domestic banking system. As capital inflows make their way through the host economy, they add deposits and hence reserves to the banking system. The rapid growth of bank reserves creates true problems. It encourages the expansion of credit and lending, which adds inflationary pressure to the country, and over time, lending may become more speculative in nature, raising the level of risk in the banking system. Third, large inflows of foreign portfolio investment raise the price of local financial assets and may cause a speculative bubble in local financial markets. As Mexico's experience clearly illustrates, countries that depend on capital inflows to increase domestic consumption or investment, finance a current account deficit, or support an overvalued exchange rate become extremely vulnerable to a sudden reduction or reversal of those flows. The resulting capital outflows put downward pressure on the exchange rate and drain foreign reserves from the central bank, which in turn causes a contraction in economic activity and credit, and often precipitates a sharp decline in local financial markets. As Mexico's recent experience also illustrates, once this process begins, it may take several years for foreign investors to regain enough confidence in the local economy and financial markets to commit additional capital. The flight of domestic capital was also encouraged due to the overvalued peso, especially given Mexico's uncertain political climate in 1993-1994. These outflows decreased the central bank's international reserves, making it more difficult to sustain the current account deficit. Although capital flight is extremely difficult to measure, it is undeniable that large amounts of capital will withdraw from Mexico in the fourth quarter of 1994 and through 1995.
Sharply, and the peso still under fire. A government austerity plan announced yesterday, and billions of dollars in assistance from the U.S. and others apparently have not bolstered the confidence of investors.
There was such panic on the Mexican stock market that some brokers advised their clients to sell regardless of the loss. When the trading ended, the market had lost another 7% of its value. That was only one blow to Americans who had $53 billion invested in the Mexican stock market before the crisis. The peso also continued to collapse. It has lost 40% of its value to the dollar in the last 3 weeks. And the crisis has grown despite $10 billion in aid from the United States and Canada, Mexico's partners in NAFTA. It erupted when the government of new President Ernesto Zedillo announced wage and price controls and spending cuts to deal with Mexico's economic problems. The country has a growing trade deficit, huge foreign debt, and soaring inflation. It also has $7 billion in short-term bonds coming due in the next 3 weeks, much of them held by American investors.